The market continues to push forward despite uncertainties. Recession and rate questions still loom. We may be in a new bull market. Endowment bucket strategies, short-term investment dynamics, all of that is causing interesting questions. And we'll cover that and more today in the Quarterly Context webinar. So welcome to the Quarterly Context webinar for second quarter of 2023 for clients and friends of the advisory group. I'm Greg Patterson, CEO. For those not familiar with the advisory group, we're a wealth and life strategy firm focused on helping business owners and leaders with their financial goals in their personal and family realms, their fiduciary and employee support efforts, and their communities through foundations and endowments. To complement the strategic goal and execution work we do with clients, our Quarterly Context webinars help make economic and other information approachable, high-level perspective regarding the economy, markets, and investor behavior patterns to help personal wealth and institutional clients make better decisions by staying more relaxed. The first section is mostly high-level, and the second section we may flip through very quickly, and then if you have questions, we're happy to follow up in separately. We try to keep the first section to about 20 minutes, and we'll circulate a video link later should you like to view some part of it again or pass it on to someone you think we can help like we've helped you. And if you have any questions, please submit them to the question box if we don't address them during the presentation. So we're going to cover a lot of the updates of a number of common things that we talked to you about. Also, again, talk about a little bit about an overview of endowment bucket strategies, short-term vehicle dynamics. And we always like to start by reminding everyone to focus on that space between things that matter and things that you can control. Things that matter are your goals and the decisions you make around those goals. Things you cannot control are markets, rates, the economy, and so forth, but you can navigate that space in the middle wisely to accomplish goals in the long run. As always, there are interesting bits and pieces of news that lead to markets to bounce around, and it's difficult to know what news will affect markets and what won't, but common questions arise when news comes out. Will this make markets go up? Will it make them go down? And sometimes it's both, and oftentimes even if there's some weak news, like still currently in some cases concerns about persistent inflation, the nervousness about the debt ceiling deal, which came through last minute, anticipation of additional rate hikes, caused some bumps along the way, but still a positive quarter in this case in terms of stocks. So it's always valuable to stay focused on the long run. Overall, in terms of some top level metrics, we've now reached 10 consecutive rate hikes, a total of 5.25%. Inflation has been gradually cooling. The May numbers annualized were 4%. The June numbers annualized were 3%. So the Fed is getting closer to where they want to be to rein in the effects of inflation, because inflation can be damaging to the economy, but it can be painful to get there going through those rate hikes because that has other economic impacts. The overall stock market in the U.S. was up almost 9%. Again, that's above what the projected year return is. That happened for a quarter, 3 strong quarters in a row, and bonds were flat to negative given some of the interest rate hike and expectation of maybe another hike or two. Overall, unemployment remains very resilient. Economic growth in terms of GDP numbers hovering around 2%. The estimates are going up a little bit in terms of growth expectations. So a number of signals there, a number of improvements, and things seem to be normalizing in general, but still some uncertainties on the horizon. Here in terms of markets for the quarter and for other periods, all green going out 5 and 10 years, which is not surprising, and some very strong numbers there. For the year, almost all green with global real estate and US bonds being negative. And for the year, here again, strongest in the US, pretty solid international stocks, 3%. That's still above the annualized rate, but looks pale compared to the big number for the US market this quarter. As we'll see in a minute, international economies are still in rate rising mode to try to rein in inflation, since it's been slower to get under control outside of the US. Long-term numbers, we look at 10 years across the US and the globe, including the US. Numbers are quite strong, above long-term averages in most cases. And so it's just a valuable reminder to keep an eye on those longer numbers. It makes the COVID market and the rate hike market and some other dips in the last 10 years seem less important when, almost as if they never happened, when the long-term numbers are quite solid. If we look at the line chart showing the market representing the world index here in blue, the COVID dip, the big rise when there was about $5 trillion injected into the economy, and then subsequently with rates going up, put a damper on the economy and markets, but really brought it back down to roughly around where the long-term projected returns are. So now with returns being strong 3 quarters in a row, a little bit above that, but hovering not too far off what long-term forward-looking 10-year projections are. So again, it's important not to get too caught up in what the peak is. Sometimes that peak can overshoot a little bit and then things normalize. In terms of valuations, with 3 quarters in a row, valuations have crept up a little bit, in particular in large cap stocks. This number here shows the S&P 500. If we look at smaller stocks, and especially on the value side, still considered to be undervalued. So for those that are highly diversified, will benefit from the elements that are still have yet to recover, and the portions of the market that where valuations look a little more stretched, it's reasonable to expect that there'll be more volatility there potentially. In some cases, maybe even more than some of the other areas which have maybe more comeback still to do. If we look at the value growth valuations here on the right, consistent with that chart in the upper right corner, you can see how value stocks look relatively undervalued from a style standpoint across that spectrum. So diversification helps. Don't get too concerned about what's out of favor. It tends to come back in favor and reward you later. The overall bond market remains inverted. It's been inverted. It's the steepest inversion, so to speak, since the 1980s. And it's been inverted for a while now, since 2022. So when there's an inverted curve, that implies that there is a recession pending, and in most cases it is a good predictor of recession, and just not when. But now this is stretched out for more than a year, and certainly stocks aren't pricing that in, but bond markets are a bit, and so there's some mixed signals out there about what the beliefs are about where the economy is headed. Speaking of that, then, what is the chance of recession now? Economists are on average expecting there could still be a chance of recession, a decreasing sense that it would be a medium or deep level of recession, which is pretty interesting despite the biggest, fastest series of rate hikes in over 40 years that lasted more than a year and a half. So possible, but there's a chance that the economy will thread that needle. Overall, in terms of growth, GDP is up 3% versus the right on track with about the 3.1% estimate. Growth is expected to cool somewhat, and different projections of that, whether you look to the Conference Board or to the World Bank, varying levels of projections, but expecting some cooling, including in the US. Most countries around the world outside of the US are still in tightening mode, as mentioned before, to try and rein in inflation, and that's dampening both returns and the economy, but still a necessary evil to get inflation under control. China cooled quite a bit to 4.5%, with growth levels looking more like developed country, still above that, but a number of dynamics that are challenging in the Chinese economy, and the overall stock market dropped almost 10%, whereas for the quarter, where it was up almost 10 in the US. Not a whole lot more to talk about. Essentially the same rate chart we've been showing, but for long-term perspective, you can see how high it ratcheted up in the 70s after sort of a much higher level of inflation. Then it came gradually back down, which gives bonds a boost. Then it laid flat, came up, went back down, now working its way back up. The good news at one level is that even though there were the unfortunate banking crises in the last couple of quarters in the U.S. For regional banks, that has led to tightening of credit, which has made it less necessary for the Fed to tighten rates and effectively put a damper on credit. So that's making the Fed's job a little bit easier. In terms of rate projections, the Fed and the market are both expecting another hike or two potentially over the course before the end of 2023 or early 24, and then some cooling is expected. And so remember that when as the bond market was negative for the quarter with some of this expectations and rate hike in the second quarter, when bond rates start coming back down and normalizing a little bit more to maybe closer to longer term, medium long-term levels, that can give bonds a boost. As rates drop, it pushes bond prices up. So just a reminder of what's out there and the normal levels of volatility that can be expected. Inflation, as mentioned before, continues to moderate. A big part of that was due to energy. So oil and energy overall dropped about 12% year over year. So that has been part of what's pulled those numbers down into more reasonable level. Wage growth, as we'll see here, has cooled off a little bit, while unemployment remains especially and consistently low relative to very long-term rates. In terms of the consumer, overall sentiment has improved a bit, which is interesting. Not surprising at some level, given that there's been 3 strong quarters in the equity market and some signs of improving housing markets in some area for those that are owners. But this, depending on what happens in the markets moving forward, and if recession picks up, because of the effect of those rate hikes over time can have a delayed effect that don't show up in the economy for 6, 9, 12, 15 months sometimes. So that's part of why there's still questions about recession. So this is an interesting measure of mood, and that is also consistent with an increase in consumer spending, despite some of the higher prices. So that's part of what's giving the GDP, our economic growth forecast, a little bit of a boost. However, we're now, the consumers that are spending and feeling more confident have burned through essentially a lot of their savings, much of which came through underspending during COVID and some of the big stimulus checks that went out during COVID. So there's a little bit of a disconnect between savings rates and the confidence levels. Usually when savings are coming down, confidence is a little bit weaker, but maybe there's a lagged effect there currently. Volatility has been low recently, with the market essentially going up for a couple of quarters. And we'll take a moment to talk about, for those that either are endowment clients or are involved with foundations that have endowments, one common approach to thinking about assets is in terms of, we like to help clients think about in terms of buckets. A lot of times an organization will approach us and they're not sure how do we manage. We have short-term needs, we have long-term needs. How do we build a portfolio that addresses that? And it can make for a pretty uncomfortable discussion or situation as a fiduciary. So one of the really helpful ways to do it is split it into timeframes. And these are approximations of how much stocks or bonds should be held. That would be customized more, but this is for general illustration. What's long-term, ultra long-term, which is fairly uncommon, long-term, very common, and then sort of medium to ultra short, depending on what the cash spending need is. And oftentimes you'd have a dedicated portion of assets that has a specific time frame, so that it's not held in the long-term assets and not subject to the volatility of the long-term assets, and therefore safer for spending when there's a specific number that needs to be withdrawn and spent at a particular time. This type of approach on a somewhat simpler and less spliced up basis is also common for our personal wealth clients when there's a material spending need on the horizon, and we often, as mentioned in our quarterly letter, encourage a couple of years worth of spending for those that are approaching or are in the retirement phase, so that their immediate spending needs aren't subject to volatility. And that can help provide a lot of extra peace of mind when markets get bumpy as well. Roughly in that same theme of short-term or buckets, and within that the short term, we're currently in an interesting environment where, with rates up, bank accounts and sweep vehicles and money market and a lot of things were all paying very low, almost no interest for a long time with such a historically low interest rate environment. But now with rates ratcheting up, there's really a big difference between what you might call regular cash, cash sweep vehicles at a brokerage account or regular savings or checking account. And the rates tend not to increase much in those vehicles, but they do increase in short-term bonds, short-term bond funds, money market funds, treasuries, and CDs. So depending on the situation, any one or a combination of these might be appropriate for short-term needs and are considered when we build those short-term buckets. Interestingly, the rates, their approximate rates, are hovering right around 5% for all of these. CDs slightly higher, but there's an illiquidity premium because you don't have full access to the money, and there's oftentimes a penalty, which may be a pretty hefty interest rate penalty, depending on when you do it relative to the length of the need. So what seems like a premium may end up being a big discount if you end up having to withdraw faster. The asset class for the corner, an interesting chart from our perspective regarding bonds, and a reminder that what some would consider to be slightly higher risk bonds, in this case, BBB rated corporate, so the lower end of corporate bonds, which is just above the junk bond level, have had more resilient yields and therefore more resilient returns over recent periods. So you can see that displayed here. Similarly, going into junk bonds, as someone call them, or high yield bonds, can have some similar dynamics. So thinking only about the highest quality, best credit worthiness is not the only factor that should be considered when building the bond portion of a portfolio. You want to have a diversified approach while certainly considering risk and credit worthiness and quality. We have a number of blog posts that you might find interesting for business owners and protecting wealth, why small or boutique wealth management firms may be a better fit for a lot of people. Some interesting tidbits there that a lot of people aren't aware of in terms of smaller firms and what the alternatives do and don't do. Interesting information about how women tend to make better investors. So that's worth a read, and men can learn from that as well. And why no one should ignore financial planning, and accomplished women are certainly part of that set as well. So we'd like to thank you for attending. We'll go into the second set of slides, sort of the detail level in a moment, but for those that wanted just the primary section, we appreciate you being here. Thank you for joining, and if you have questions, please let us know either in the chat box or separately by email, or give us a call. And we very much appreciate your attendance and the relationships we have with you. So to jump in, just very quickly run through the part two. There's a few rules and regulations updates here. Not really anything necessarily to act on, but just some context. There isn't too often news around foundations and endowments. Something did come up here regarding transparency. So that's one interesting dynamic, but really more related to college entities, not non-college endowments. 403B plans may be allowed to use collective investment trusts, which is like a mutual fund but not publicly traded. So that opens up another window of potentially reducing investment costs in some cases where minimums can be met. Then a few other elements to take a peek in if you're interested sometime. We covered most of this here, so a few additional details, which is for reference. Some of these charts we've looked at already. It's interesting to see the earnings numbers for the S&P continues to be strong, and projected numbers continue to rise, and that's part of what's those projections are some of what's supporting the current stock market strength. So showed this valuation chart before. Another similar chart shows spliced out the U.S. market into different pieces, and you can see growth in general. Large cap growth are the most richly valued, so to speak. In some cases, maybe that may be merit. In other cases, it may be partially momentum. So again, there may be more risk embedded there in terms of volatility on the horizon. The 4 bad bears chart shows where we are on an inflation-adjusted basis, so far ahead of the other 3 worst markets in history after the global financial crisis and the COVID dip, and then the recent rate dip. More about splices up of long-term numbers. Interesting to see, those that held from the low of COVID have had some very strong results, and those that got out of the market because of concern and didn't know when to get back in or just ignored it, missed out on essentially, in many cases, doubling their portfolio. So discipline, even though it's uncomfortable, is very important. Just an image of market cycles for those that like to kind of see where we are and what some of the typical patterns and implications are. More information on the consumer, so for some of which we just showed, but interesting to see how household debt service has increased. So people have taken on more debt as they've been maybe a little bit more confident with their economy and their job situation. Overall, for the last year, higher quality stocks have done better. For the last quarter, large cap growth and lower quality have done better. So a little bit more speculative, which has also, again, led to some of those stretched, maybe a little bit more stretched valuations. Capital market projections, which we've talked about before, won't go into detail here, and a reminder of the overall 5-step process we help all of our clients with in different ways depending on the client type. And then a summary of investor behavior studies specific to institutions. So if you are an institutional client and would like to review this again, please do. It's not just individual investors that are subject to decisions, and most of our clients avoid all of these problems. But that can be, some of these things can be helpful, especially if you have new board or committee members joining who may not have had as much of a formal and proven process. Some of this data can point to things to avoid. So thank you very much. Again, we'll take a peek at the questions in a moment, and appreciate you being here today.